Here we go. One step at a time, don't be living on the line.
In today's lesson, we're going to explore how a change in the flow of goods and services and financial assets between two countries should affect the exchange rates of those two countries' currencies, and conversely, how a change in the exchange rates between two countries may ultimately affect the flow of goods and services and financial assets between those countries. As you can probably tell, we're going to examine the United States and China, and in as basic a way as possible, examine how the flow of goods between these countries may affect the exchange rates of the Chinese RMB and the United States dollar. So on the page here, we have two countries, China and the United States. We have two currencies, the Chinese RMB and the US dollar. And we have two foreign exchange markets. The two foreign exchange markets we're going to be examining are that for the US dollar in China and that for the Chinese RMB in the United States. So in our analysis, we're going to show how the export of goods from one country to the other country will or should affect the exchange rate of both countries' currencies, and how the import of goods will affect exchange rates. We'll also show how a change in the exchange rate due to an intervention by one of these countries' central banks could affect the flow of goods and services between the countries. Let's begin our analysis by examining some actual trade data from the last few years between the United States and China. The table shows the United States exports to China in each year and the US imports from China in each year. Let's look at the most recent year. We can see that in 2010, the US exported about $92 billion worth of goods and services to China, but it imported $364 billion worth of goods and services from China. This gives us a total volume of trade between China and the United States of $456 billion. But of that, $271 billion more is being imported into the United States than is being exported to China. The negative $273.1 billion represents the United States trade deficit with China in the year 2010. A trade deficit exists anytime a country's imports are greater than its exports to the trading partner. So this equals a current account deficit. Notice, looking back at the last decade, that the United States has had current account deficits with China in each of the years depicted in this table. Between 2001 and 2008, the current account deficits grew annually, reaching $266 billion in 2008. During 2009, however, the U.S. current account deficit with China fell, and this is most notably because U.S. imports from China fell from $337 billion to $296 billion. This can be accounted for by the fact that the United States was in a recession in 2009, and due to the falling incomes among American consumers, the consumption of all goods, both American-produced goods and Chinese-produced goods, declined. So here we have established that over the last decade, in each of the years, the United States has bought more goods and services from China than China has bought from the United States. Now let's move this table aside and illustrate what this would look like graphically on the foreign exchange markets for the US dollars in China and for the Chinese RMB in the United States. So let's imagine a simplified version of the trade that takes place between the United States and China. The United States produces airplanes, and we're going to assume that China produces smartphones, now let's start with a US consumer buying Chinese smartphones. In order to buy smartphones made in China, the United States must supply dollars to the Chinese producers of smartphones. US consumers earn dollars in the resource market, therefore we have to spend dollars on Chinese goods. So let's illustrate the purchase of Chinese smartphones by showing a flow of dollars into the Chinese economy. Let's say that $200 worth of smartphones are purchased from China. So now America has smartphones and China has US dollars. How would this look in the market for US dollars in China and in the market for Chinese RMB in the United States. The inflow of dollars into China is illustrated as an increase in the supply of dollars in China. We can show that by shifting the supply of dollars curve out, and this should cause a depreciation in the value of the US dollar. The increase in supply of dollars causes the dollar to become weaker in China. Dollars are now less scarce than they were before. So the equilibrium exchange rate of the US dollar in terms of RMB should decline following the increase in demand for Chinese smartphones in the United States. Now, meanwhile, in the market for Chinese RMB in the United States, we should see the demand for Chinese RMB increase. In order to buy these Chinese smartphones, American consumers will supply their dollars and demand Chinese RMB. So the increase in demand for RMB should cause the exchange rate of the RMB to rise. So we have now seen a depreciation of the dollar resulting from an increase in demand for Chinese goods and an appreciation of the Chinese RMB. But of course, trade is not a one-way road, it is a two-way road. So while the Chinese are exporting smartphones to the United States, they must acquire the goods that they are unable or are not yet producing domestically. And that is airplanes. Airplanes are a major export to China from the United States. In order to acquire American-built airplanes, Chinese airlines and other consumers of airplanes must supply Chinese currency to the US market. Of course, Chinese firms earn Chinese currency. Therefore, in order to acquire American airplanes, they must exchange their Chinese currency for US dollars. So, in the meantime, airplanes are being exported to China and Chinese RMB are being supplied to the United States. So in our graphs, we can show this exchange as follows. The increase in demand for US goods from Chinese consumers causes demand for dollars to rise in China, putting upward pressure on the dollar exchange rate in China. So we'll see the exchange rate for the dollars rise once again once Chinese consumers have begun demanding American planes. In the meantime, the inflow of Chinese currency into the United States causes the supply of Chinese RMB to rise in the United States, putting downward pressure on the value of the Chinese currency. So once again, we should see the exchange rate adjust as goods and services flow between these two countries. As American households demand Chinese goods, demand for Chinese currency rises and the Chinese currency appreciates. The supply of US dollars rises and the US dollar depreciates. However, as Chinese consumers demand American-produced goods, demand for dollars rises, and the supply of RMB rises, causing the RMB to depreciate and the dollar to appreciate. This is basically how the flow of goods and services between two countries affects exchange rates. In order to buy a good produced in another country, consumers in the importing nation must demand that country's currency and supply their own. Now this raises a question. If the flow of goods and services causes the exchange rate to rise and fall between two nations, then you would think that the imbalance of trade that we witnessed when we studied this table to begin, that negative $273 billion of America's trade balance, should not occur. The huge deficit in trade between the United States and China implies that the U.S. is spending far more on Chinese goods than Chinese are on American goods. This should, over time, mean that the demand for Chinese currency is rising more rapidly than the demand for U.S. currency is rising. The stronger RMB in the long run should make Chinese goods more and more expensive and therefore less and less attractive to American consumers. But this has not happened. Clearly, for the last decade, exports from China to the United States have exceeded imports from the United States to China every single year. Why has the Chinese currency not appreciated so much that the U.S. consumer has found Chinese goods too expensive to continue to consume? In the next part of this lesson, we're going to show how Chinese central bank intervention in the foreign exchange market has kept the value of the dollar higher than it would be under a completely free floating exchange rate system. In other words, the Chinese government has kept the Chinese currency artificially weak by buying United States government bonds and thereby increasing the demand for US dollars and keeping the dollar artificially strong. So now let's examine the outcome of the trade that we illustrated previously in this lesson. Now China has its airplanes. It bought these airplanes from the United States by exchanging the Chinese currency for US dollars. That's how the US ended up with some Chinese currency. The United States has smartphones. It bought these smartphones by exchanging US dollars for Chinese currency. This is how China ended up with US dollars. The question, though, is if the US year after year is buying more Chinese goods, spending more on those goods than China is on American goods, over time, American dollars must be accumulating in China. We'll see dollars flow to China at a greater rate than Chinese currency is flowing into the United States. Dollars are pooling up in China, but they're not using these dollars to buy American goods because, as we saw in our table, the Chinese import of American goods is much less than America's import of Chinese goods. So there is not a subsequently equal flow of Chinese currency into the United States. This means that over time, the demand for RMB is rising faster than the supply of RMB. This should cause the exchange rate to rise in the United States for Chinese currency. But this is not happening. The Chinese currency is what we call a managed exchange rate. And what is actually happening is the Chinese government is funneling dollars back into the United States and keeping demand for dollars high by purchasing United States assets. And the primary asset that the Chinese government is purchasing is United States government debt. That's where this bond certificate comes in. In order to keep the demand for US dollars high, what the Chinese government does is that it prints its own currency, as we see here. It exchanges them for United States dollars, keeping the demand for dollars in the foreign exchange market high. This puts upward pressure, as we can see, on the value of the US dollar and keeps the exchange rate high. So even as dollars flow into the foreign exchange market in China due to America's large demand for Chinese goods, the Chinese central bank continually keeps the demand for dollars strong, thereby keeping the exchange rate higher than it would be under a free floating exchange rate system. The purchase of US government bonds keeps money flowing from China back into the United States, allowing Americans to continue buying Chinese goods without having to sell them more and more airplanes. The result of this is that the dollar remains strong, the RMB remains weak, since the Chinese are continually increasing the supply of their own currency in order to buy the US dollar denominated government debt. So under a free floating exchange rate system, what we showed in the first half of this lesson would probably occur. As Americans demand more Chinese goods, the Chinese currency would get stronger and stronger, making Chinese goods less and less attractive to American households. In the meantime, American goods would become more and more attractive to Chinese households. Under a free floating exchange rate system, the massive current account deficits that we showed in our table at the beginning of the lesson would be narrowed over time, and trade between China and the United States would be more balanced. However, through its purchase of US government debt, the Chinese central bank is able to take the dollars that Americans spend on Chinese goods and funnel them back into the US economy without actually having to buy American goods. The Chinese are now the largest foreign owners of US government debt. Through its purchase of US government debt, the Chinese central bank has kept demand for dollars high and kept the dollars that Americans spend on Chinese goods flowing back into the US economy. This allows Americans to enjoy low tax rates and low interest rates on its government debt due to the willingness of the Chinese central bank to lend the US government the money that we spent on their goods and services. The trade imbalance that we saw in our table is perpetuated due to this managed exchange rate system by the Chinese government. Now, it's probably not the only reason that the US has a large trade deficit with China. If the currency were allowed to float freely, China would certainly still have a comparative advantage in the production of most manufactured goods due to the very high population in China and the relatively low wages at which workers are willing to work. However, the management of the Chinese currency, accomplished by the purchase of U.S. government bonds by the Chinese central bank, has managed to keep demand for U.S. dollars strong in foreign exchange markets and the supply of Chinese RMB high, keeping the RMB weak and the U.S. dollar strong, contributing to the trade imbalance that has characterized trade between the United States and China over the last decade. So that wraps up this lesson. The purpose of this lesson was to show how the flow of goods and services affects the exchange rates in a free-floating exchange rate system. However, through one country's management of its currency, accomplished through financial market transactions, including primarily the purchase of U.S. government debt by the Chinese central bank, the exchange rate of the Chinese currency and the U.S. dollar is able to be managed by the Chinese central bank in such that the Chinese currency is kept weaker than it would be under a free-floating system and the dollar kept stronger than it would be, thereby perpetuating the trade imbalance that has characterized the last decade of interactions between these two countries.